You got the raise, the one you've been waiting on for 18 months. Your manager shook your hand, HR sent the paperwork, and you did the math on the drive home. $12,000 more a year. $1,000 a month. You started thinking about what that meant. The credit card you could finally pay down. The vacation fund you could actually build. The breathing room that had been just out of reach for 2 years. Then the first new paycheck landed. The number was not what you calculated. Not even close. You got $1,000 more gross and somewhere between $580 and $680 more net depending on your state. The rest went somewhere you didn't send it. And if you're like most people, you looked at that number, felt a vague frustration you couldn't quite name, and moved on. That gap, between what you earned and what you kept, that's not an accident. That's a system, and the raise is just where you can see it most clearly. The invisible tax on middle-class income runs every single month whether you get a raise or not. And by the end of this video, you're going to be able to see exactly where it goes, how much it's actually costing you over a lifetime, and the 3 places it hits hardest that almost nobody is talking about. My name is Nick, and I spend a genuinely unreasonable amount of time mapping the places where regular people's money quietly exits without permission. If you've ever felt like you're earning more than you used to, and somehow not getting ahead any faster, subscribe and hit that like button, because today, we're following the money to exactly where it goes. Quick thing first, not a financial advisor, not financial advice, just math, patterns, and the part of the pay stub they don't put a label on. Let me introduce you to 2 people, Tyler and James. Same company, same role, same $78,000 salary. Tyler is single, renting in a mid-cost city. James is married with 2 kids, owns a home in the same metro area. On paper, they're identical employees earning identical money. In practice, they are being taxed by completely different invisible systems simultaneously. And neither of them has ever sat down and actually calculated what those systems cost them annually. Hold on to them, we'll come back. Here's the framing that makes everything click. When most people think about taxes, they think about one thing: federal income tax. The line on the pay stub everyone looks at, and that number is real. But federal income tax is actually the most visible and most discussed tax in your entire financial life. It's the one with the lobbyists and the debates and the political ads. The invisible taxes are the ones nobody campaigns about, the ones with no refund, the ones that compound quietly in the background of every financial decision you make for your entire working life. There are 3 of them, and they work together in a way that makes the total cost almost impossible to see unless you're looking for it specifically. The first invisible tax is the marginal rate illusion. Here's what most people believe. If you're in the 22% tax bracket, 22% of your income goes to federal taxes. That belief is wrong, and the difference between the belief and the reality shapes how millions of people think about raises, side income, and financial decisions every single year. The U.S. uses a progressive tax system. You don't pay your bracket rate on all your income. You pay it only on the dollars that fall within that bracket. The first $11,600 of income in 2024 is taxed at 10%. The next chunk up to $47,150 at 12%. Only the dollars above that threshold hit the 22% rate. So someone earning $78,000 doesn't pay 22% on $78,000. They pay a blended effective rate that lands somewhere around 16% to 17% for a single filer. That sounds like good news, and it partially is. But here's where the illusion turns costly. Because people believe they're in the 22% bracket and paying 22% on everything, they systematically underestimate the value of pre-tax moves. A $6,000 contribution to a traditional IRA doesn't save you 22% in taxes. It saves you your effective marginal rate on those specific dollars, which for most middle-income earners is somewhere between 22% and 12%, depending on where those dollars fall. People who understand this use it. People who don't leave real money on the table every single year. Tyler contributes $6,000 to his traditional IRA annually. At a 22% marginal rate on those dollars, he saves $1,320 in federal taxes this year alone. Over 30 years of contributions, assuming similar tax treatment, that's roughly $39,600 in taxes he never paid. Money that stayed invested and compounded instead of going to the IRS. James contributes nothing to an IRA because he thinks the tax benefit isn't worth the complexity. He's been wrong about that for 11 years. The marginal rate illusion costs people not because they're overtaxed. It costs them because they don't understand the system well enough to use the legal escapes that exist inside it. The second invisible tax is the one nobody sees coming, and it hits hardest right when things start going well. It's called bracket creep, and it's been quietly picking the pocket of every middle-class earner in America for decades. Here's how it works. Tax brackets are adjusted for inflation each year, but your salary may be growing faster than those adjustments. And even when they keep pace, raises that feel like real income gains often aren't because inflation erodes purchasing power simultaneously. You earn $5,000 more this year. Inflation runs at 4%. Your real purchasing power gain is somewhere around $1,800 to $2,200 depending on your specific spending profile. But your taxes are calculated on the nominal $5,000 increase. So you're being taxed on income growth that isn't entirely real. The IRS taxes nominal income. Inflation taxes real purchasing power. Together, they take a cut from both sides of the same raise. Let's run the numbers on Tyler specifically because the math is more alarming than the concept. Tyler earns $78,000. He gets a 4% raise this year, roughly $3,120 more gross. Inflation is running at 3.5%. His real purchasing power increase is approximately $390 for the year. His tax bill increases by roughly $686 because the raise pushed more dollars into higher marginal territory. He earned $3,120 more nominally. He kept about $2,434 after taxes. Inflation eroded $2,044 of that in real purchasing power terms. His actual real financial gain from a 4% raise in a 3.5% inflation environment is somewhere around $390. He celebrated a raise that delivered $32 of real gain per month. That's not a failure of discipline or financial planning. That's two invisible systems working simultaneously on the same paycheck. Neither of them announced themselves. Neither of them sent a bill. They just quietly processed through the numbers while Tyler was focused on the gross figure. The third invisible tax is the one with the most total lifetime cost and the least public conversation. It's the opportunity cost tax, and it operates not on what you earn but on what you spend. Every dollar you spend today has a shadow cost. That shadow cost is what that dollar would have become if it had been invested instead and left alone for 20 or 30 years. At a 7% annual return, the rule of 72 tells us money doubles roughly every 10 years. A dollar spent at 35 isn't costing you a dollar. It's costing you $2 at 45, $4 at 55, $8 at 65. Most people know this in the abstract. Almost nobody actually applies it to their daily spending decisions because the math is invisible and the spending is immediate and tangible. Here's where it becomes genuinely alarming when you attach real numbers to it. The average American household spends approximately $3,000 a year on subscriptions. Streaming services, software, gym memberships, apps, delivery subscriptions, news sites. Most of that spending is on subscriptions that aren't being fully used. A 2023 study by C+R Research found the average American underestimates their monthly subscription spending by about $133 per month. They think they're spending $86. They're actually spending $219. $3,000 a year in subscriptions invested at 7% over 30 years is $283,000. Not from a massive financial sacrifice. From the background spending most people have never actually audited. James, the married homeowner, has a more complex version of this problem. He has the subscription layer. He also has what financial researchers call the consumption smoothing trap. When income goes up, spending rises to match it almost immediately. A raise arrives, the family upgrades the car lease, adds a streaming service, books a nicer vacation. Each upgrade individually is affordable. Collectively, they consume the entire income increase within 60 to 90 days. The raise disappears into lifestyle, and the opportunity cost clock starts running on every single dollar of it. This is why households earning $150,000 sometimes have less actual wealth accumulation than households earning $90,000 with better margin discipline. The invisible tax on high earners isn't just the higher marginal rate. It's the lifestyle expansion that follows the income increase and converts potential compounding into immediate consumption. Now here's the research that reframes all of this in a way I think is genuinely useful. A 2019 study from Vanguard analyzed the actual investment behavior of 900,000 account holders across income levels. What they found wasn't that high earners were dramatically better investors. What they found was that the single biggest predictor of long-term wealth accumulation wasn't income level, investment selection, or market timing. It was savings rate. Specifically, the percentage of income that went into investment accounts before it had a chance to hit the checking account and get spent. The people who accumulated the most wealth weren't the ones who earned the most. They were the ones who automated the gap between income and lifestyle before the invisible taxes could close it. That's the framework. 3 moves that directly address the 3 invisible taxes. Move 1 addresses the marginal rate illusion. Max your pre-tax accounts first. Traditional 400 and 1,000, traditional IRA if eligible, HSA if you have a qualifying health plan. These contributions come off your taxable income before the IRS calculates what you owe. Every dollar in a pre-tax account is a dollar that bypasses the marginal rate illusion entirely. For someone in the 22% bracket, maximizing a 400 and 1,000 at $23,000, the immediate tax saving is $5,060. That's money that stays invested and compounds rather than funding someone else's priorities. Move 2 addresses bracket creep. Track your real raise, not your nominal raise. Every time you get an income increase, calculate what inflation was running at that same period. That's your real gain. Only allow lifestyle spending increases proportional to your real gain, not your nominal gain. If your raise was 4% and inflation was 3%, your real gain is roughly 1%. Your lifestyle can expand by 1%. The other 3% goes to investment accounts before it becomes visible in your checking balance. Move 3 addresses the opportunity cost tax. Run a subscription audit once a year. Every recurring charge, every auto-renewal, everything. Cancel anything you haven't actively used in 90 days. Take the monthly total of what you cancel and automate that exact dollar amount into an index fund the same day. You won't feel the lifestyle change because the spending was already invisible. But the compounding starts immediately and runs silently in the background the same way the invisible taxes do. Fighting invisible money losses with invisible money gains. Tyler runs all 3 moves, not perfectly, but consistently. His effective tax rate on each raise is lower than the headline number because the pre-tax contributions shrink his taxable income. His lifestyle spending grows at roughly his real income growth rate, not his nominal rate. His subscription audit last year recovered $147 a month he genuinely didn't notice was leaving. James hasn't run any of them, not because he's irresponsible, because nobody ever explained to him that the invisible taxes exist, let alone how to address them. He's been fighting a 3-front war without knowing there was a war. Here's the truth I'd want someone to tell me directly. The middle-class invisible tax isn't one thing you can fix with one move. It's 3 separate systems running simultaneously on your income from 3 different angles. Federal tax brackets working against your understanding of your own marginal rate. Inflation and nominal income growth combining to tax real gains that are smaller than they appear. And opportunity cost silently converting present spending into future wealth that never gets built. You can't see any of them on your pay stub. You can't call to dispute them. They don't send a bill, they just run. But now you can see them, and seeing them is the entire game. Because every one of the 3 has a direct countermove that's available to any W-2 employee regardless of income level. The pre-tax account, the real raise calculation, the subscription audit. None of them require a financial advisor. None of them require a 6-figure salary. They just require knowing the invisible systems exist and deciding to run the countermoves before the systems run first. Tyler knew. James didn't. Same paycheck, different outcome. And the only thing that ever separated them was whether they could see the invisible tax or not. Now you can. If this changed how you think about where your raise actually goes, drop a comment below telling me which of the 3 invisible taxes has been hitting you hardest. I actually read them. And if you want the full picture on how net worth levels change the way the financial system treats you, that video is on the screen right now. Go watch that one next. I'll see you in it.